The great thing was I didn't have a lot of credit card debt. I had very small credit cards. I had a lot of maybe little open store credit cards where they just had very small balances. So I made sure I had all of that paid off. I think the banks still looked at it like she doesn't have a lot of credit. I didn't have a house at the time. I had a car payment and I had a couple of very small credit cards, but I didn't have a lot of equity, and I think that was the thing that was scary for maybe larger banks.
Northern Initiatives is committed to entrepreneurs like you because you are the people who are creating jobs and enabling the communities of our region to thrive. After completing this module, you will be able to explain how the personal finances of a business owner impact the business's ability to get credit. Explain the concept of credit reporting and the impact of credit reports on the operation or growth of a small business. Identify the credit reports and other reporting systems commonly used to assess the risk of extending credit to a small business. Explain how these credit reports work, and identify strategies to build or improve credit.
As a new business owner, your personal credit is your foundation to build the business. Having the best credit possible may save significant time, money, and help launch your business. For most lenders, the business owner's personal credit score is an important classifier because it is a point of view for how well you manage your finances and how you take on risk. If you are a new business owner, a person who is young enough to have not built credit yet, or if you have some personal credit issues to repair, you need to develop a positive credit history. Before you apply for credit, it's a good idea to order and review your personal credit report through annualcreditreport.com to ensure your credit report does not contain inaccurate information. If there are errors on your report, provide copies of all documentation to support your claim when you file the dispute. Send copies of the documentation directly to the creditor that provided the inaccurate information, as well as the credit bureau. Once the error resolution process is completed, request an updated credit report from all 3 major national credit reporting agencies to verify that the changes were made. A consumer reporting agency is any person or business that assembles or evaluates credit information on consumers for fees or dues and furnishes these reports to third parties. For consumers, there are 3 major credit reporting agencies: Experian, Equifax, and TransUnion. They are the free, trusted resource that should be used for inquiries. You can find their contact information through www.annualcreditreport.com. As a small business, if you have a permissible purpose to obtain a credit report on a consumer, you can access the information gathered through these 3 key reporting agencies either directly from them or indirectly through one of the many other consumer reporting agencies. You can find some of these additional agencies by searching the Internet. If you obtain a credit report, use it solely for the purpose intended, such as to make a decision whether to extend credit to a customer. Do not pass the credit report on to a third party. Doing so can result in your firm being considered a consumer reporting agency, causing additional legal liabilities. Legal standards and regulations for requesting and using a credit report or reporting to a consumer reporting agency is important for you to know and follow. Now, your credit score is a number that summarizes your credit risk based on a snapshot of your credit report at a particular point in time. A credit score helps lenders evaluate your credit report and estimate your credit risk. The most widely used credit scores are FICO scores, the scoring model created by the Fair Isaac Corporation. Scores are based solely on information in consumer credit reports maintained at the credit reporting agencies. Your credit score influences the credit that's available to you and the terms such as interest rate that lenders offer you. It's a vital part of your credit health. Your report details your credit history as it has been reported to the credit reporting agency by lenders who have extended credit to you. So your credit report lists what types of credit you use, the length of time your accounts have been open, and whether you've paid your bills on time. It tells lenders how much credit you've used and whether you're seeking new sources of credit. It gives lenders a broader view of your credit history than do other data sources, such as a bank's own customer data. Your credit report contains many pieces of information that reveal many aspects of your borrowing activities. The ability to quickly, fairly, and consistently consider all this information, including the relationships between different types of information, is what makes credit scoring so useful. For most major scoring models, whether you repay loans as agreed, on time, is generally the most significant factor influencing your score. That's why it's important to pay your bills on time. Another key component of your credit score is how much you currently owe on each account compared to its original loan amount or credit limit. Additional factors include how long you've had your current loans and credit cards, the types of credit accounts you have, and how many recent credit inquiries you have. These are requests by lenders for your credit report or score in response to your applications for new credit. Contrary to common misconceptions, your credit score will not be lowered when you order your own credit report. In addition to ensuring that your credit reports are accurate, consider the following to improve your scores. Pay your loans and other bills on time. Even if you fell into trouble in the past, you can rebuild your credit history by beginning to make payments as agreed. Paying your debts on time will have a positive effect in your credit score and can improve your access to credit. Minimize how much you owe in relation to your credit limit to show that you're not overextending on debt. Do not automatically close accounts that have been paid in full and have not been used for a while, because that can lower your available credit and make the ratio of credit used to credit available worse. The exception is an account that continues to be assessed monthly fees even with a zero balance. Think carefully before applying for new credit, as credit inquiries can lower your score. The Fair Credit Reporting Act, or FCRA, governs the collection, assembly, and use of consumer report information. The Act sets forth legal requirements for your business in all aspects of the credit reporting process, from furnishing credit information to an agency to how to use credit reports ordered from an agency. For example, the law limits when you can request a credit report on a consumer. It governs how you may use credit scores. All consumers, including you and your customers, have protections under the FCRA. Violations of this act expose your business to significant and costly legal damages, plus potential damage to the reputation of the business. To make a decision on your business loan application, lenders will likely ask for your permission to review your personal credit reports and contact your bank to verify your handling of checking accounts and existing loans. It's very common that a lender will ask you to personally guarantee a loan to the business. Exceptions might include lending for well-established businesses with exceptional financial and repayment performance history. Obtaining the loan may be important to the business, but naturally, as a guarantor, you are personally liable to repay the loan even if the business does not perform well. These risks should be carefully reviewed before signing the loan agreement. Consider seeking advice from an accountant and attorney before borrowing money for your business. Being a personal guarantor means that you are liable for the loan if your business is not able to make the payments. You will be required to make the payments from your personal funds. You may also be asked to pledge personal assets as collateral to secure a loan. If your home is collateral for the loan to the business, failure to pay the loan could result in foreclosure and loss of your home. If you do not qualify on your own for a loan, a lender may require another creditworthy individual to sign as a guarantor. Federal rules limit when a creditor may specifically seek an applicant's spouse as a cosigner or guarantor. These rules vary depending on the circumstances, such as whether any property securing a loan is held jointly or whether you are in a state that allows community property. A small business credit report contains information provided by banks, lenders, investors, landlords, other businesses, and government agencies. A business credit report contains an analysis of creditworthiness, insurance underwriting, employment, certain licenses, continued credit terms, and business needs. Credit reporting agencies collect information on bank accounts, payment histories, judgments, collections, tax liens, and unpaid lawsuits. Credit reporting agencies use previous addresses of the business, former names of the business, and the tax ID number to identify the small business. Some, but not all banks and vendors will report your payment history. Credit reports may be used by or involve a small business owner in any of three ways. As a borrower seeking credit, creditors or suppliers review your credit history to determine whether they will grant you credit and on what terms. As a report user, you request the credit report of a potential customer or a vendor. You may use the report to set credit terms for a customer seeking to make a purchase. You can also use the reports to help assess and manage the risk of a vendor or supplier not fulfilling their contractual obligations. As a reporter of information, your business submits credit information related to accounts owed to your business. When a customer pays their debts in a timely manner, you provide this information to the credit reporting agencies. As you are getting started in your business, you can use your personal credit for the business. However, establishing credit with a credit reporting service in the name of the business is very important. Businesses involved in extending credit use these reports to determine terms of financing. To start the process of building a credit file for your business, obtain a tax identification or ID number from the Internal Revenue Service, or IRS. Next, obtain a unique identification number for your firm called a Data Universal Numbering System, or DUNS number, through www.dnb.com. Once you have obtained the DUNS number, become a subscriber of a reporting service by submitting financial statements and registration information on your business to one of the 3 major national credit reporting agencies. Here is general information that a business credit report would include. It varies from institution to institution if they get used. A business credit report includes information such as commercial credit risk score, potential for business failure indicators, credit filings in existence for secured property, business ownership information, other businesses owned by the same organization, public records of security interest filings, which provides notice to other creditors that property cannot be used as collateral for another loan. Each reporting agency usually provides a free business credit report and for a fee may provide additional information such as agency summary of financial and non-financial accounts, public records of any Secretary of State business registration, scores from another reporting agency, payment trend and payment index comparisons to the industry norm over a 12-month period. The 3 major national business reporting agencies are Dun & Bradstreet, Experian Business, and Equifax Business. Each of these agencies has extensive information on their websites regarding their services.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and we care a bit more because it's not profit for us, it's prosperity for all.